In one of my latest videos, in fact, it was this one on the top safe ETFs to buy for a market crash. Watch it if you haven't because it's relative to this video. But there were two ETFs that really stood out to me. In that video, I talked about all the different strategies and techniques that different funds can use to give you downside mitigation. There's some low volatility funds like this one, USMV, SPHD, which is low volatility, high dividend ETF. But you're going to notice that most of these in 2020, the latest market crash, they still fell and fell hard in a lot of cases. Even when we look at the ETFs that implement some kind of diverse option strategy, most of them still have pretty massive corrections, except for two, NUSI and Swan. So I wanted to dedicate this video to going over these two ETFs that seem to never want to crash. Alright, so we're looking at NUSI and Swan side by side right now. Unfortunately, both these ETFs aren't that old, especially NUSI, but NUSI was around just long enough for the crash of 2020, and we can see that it did its job and it didn't really crash. To put this a bit more in perspective, let's put it in the S&P 500 to see how it's performed against the market. And yeah, we can see the major crash here in 2020, in which both of these ETFs really didn't participate in. To drive home the point even more, we can compare it versus a quote-unquote low volatility ETF like SPHD. And in comparison to this ETF, again, the crash that happened is severely mitigated with these two funds. So let's take a dive into both these ETFs, beginning with Swan, to see what the strategy is and why they don't seem to ever want to crash. So this is the basics of Swan. It follows this index, and the index's investment strategy seeks uncapped exposure to the S&P 500 while buffering against the possibility of significant losses. Approximately 90% of the Black Swan ETF will be invested in US Treasury securities, while approximately 10% will be invested in SPY leap options in the form of in-the-money calls. So that's the basics of this fund, but of course we have to look into the documents to really get a good understanding of how it's actually functioning. And this paragraph here explains how the SPY leap options work, which is really where all the magic comes from. So the SPY leap option portfolio is comprised of in-the-money leap options that, at the time of purchase, have expirations of at least 1 year and 1 day in the future and expire in either June or December. An in-the-money option contract is an option contract with a strike price that is below the current price of the underlying reference asset. For the SPY leap options in which the fund invests, the reference asset is the S&P 500. The leap options will generally have a delta of 70 at the time of purchase, meaning that for every $1 of movement in the share price of SPY, each leap option will have a corresponding movement of 70 cents. And it goes on to say that that relationship is in both directions, so to the upside and to the downside. Okay, so let me try and put that into a visual format. So as we just saw, these SPY leap options are long-term options. They're at least 1 year and 1 day long, based off of the S&P 500, and they represent 10% of the portfolio. So first, a quick list of pros and cons. The first pro is that these are leveraged. So one contract usually controls 100 shares. So in case you're asking why is it only 10% of the portfolio, that's why. It's leveraged. So you can control a lot more shares with less capital. That does lead to the first con, which is more volatility, just because the leveraged nature. Another pro is limited downside. I'll talk more about that in a second. And another con I want to point out is that these are options, not equity. So long term, if you want to have the best returns, just buy the S&P 500. Don't buy options off of it. Okay, so this is the S&P 500 over the past 5 years. And to make this a very simple explanation, let's split it up into 1 year increments. As we saw in the document, the strike price is in the money. So what that means is at the time of purchase, the strike price is below the current share price. And essentially the only thing going on with these leap options is you're hoping that over the next year, these long time frames, the S&P 500 or the general US economy grows. That's what you're hoping for. And historically that has been a winning bet. This is the S&P 500 return year by year, and most years it is positive. The US economy tends to grow over long periods of time. Although it is important to note that occasionally the S&P 500 does have negative years. And that, of course, is the downside of these leap options. If the year ends with the stock price below the strike price that you initially bought it at, that's a complete loss and the contract expires worthless. Although something to note is in comparison to equities, these actually have a limited downside because if you just bought the S&P 500 over here and then it crashes, you're going to go down with the market. So if the market crashes 50%, you're going to go down 50% in value. With these leap options, you can only lose what you bought the contracts for, because if the contract expires worthless, then it's worthless and you lost what you paid for it. But of course, on the flip side of this, equity positions can go up without limit. So to put it simply, that's how Swan avoids major market crashes, by betting long-term on the growth of the US economy and having 90% of its assets in US Treasury bills, which are very stable in nature. Now, if we switch our focus to NUSI, this one also manages to avoid major market crashes, as we can see here, but it does it in a different way that I think is way more simple and easy to understand. So visually, this is how NUSI operates. It's important to note that NUSI is based off of the NASDAQ index instead of the S&P 500, so that's a pretty major difference right there. But to put it simply, they have covered calls that are 10 to 15% out of the money, which generate income that is paid out in the form of dividends, and some of that income is taken and used to buy protective puts, which are also 10 to 15% out of the money on the downside. So that results in NUSI having this range that it operates in, plus or minus 10 to 15% per month, while of course giving you pretty hefty dividend payments with the rest of the covered call premiums. I can also give you a nice little visual of what's going on here. So this is the QQQ, and we can see vertically here how it's split up month by month. The months are down here on the x-axis. And this isn't going to be to scale like the exact percentages. It's just to give you a rough idea how this works visually. So at the beginning of every month, it locates the strike price. So say for April, it's right there. And then it simply writes and sells a call option 10 to 15% out of the money. And it uses some of that premium collected to then buy a put option that's also 10 to 15% out of the money. So if you will, you can draw a line going across that whole month. And this is going to give you that upper and lower range where NUSI operates. And using this month as an example, assuming this is to scale, the call options will be working against you because it will be capping your upside potential, and the put never comes into play. However, the previous month, the story would be very different. So at the beginning of the month, the price is right around here, so they would do the same thing. They would buy a call option up here and a put option down here. We can draw those lines going across for the entire month, and we can see here how the put option will kick in and keep you from suffering that loss. All the while, the extra premium generated from the call option is being paid out to you on a monthly basis as a pretty high dividend. So in a nutshell, that's essentially how these funds operate to avoid major crashes. Very different, as you can see. Swan, keep in mind, is 90% treasury notes, so that provides the stability, but 10% are these SPY leaps, which are leveraged, and it's why, even though it's only 10%, it has a greater impact on the overall returns. But with these long-term 1 year plus SPY leap options, you're essentially just betting that the overall US economy will continue to grow, because historically that is what tends to happen, although there definitely is risk because sometimes there are sharp declines, and depending on when that happens, that could negatively affect the strategy. Although that is why 90% of the ETF is treasury notes. And NUSI is much more simple. Every month it sets an upper and a lower limit, and you operate within that range while getting pretty nice income in the form of high dividend payments. So I have to say, I'm very impressed by both these funds' ability to not have sharp declines. Over long periods of time, especially NUSI, it definitely can have a slow bleed out, but its main goal is avoiding sharp declines, and that's exactly what it does. Even when we compare it against some of my favorite ETFs like Divo, keep in mind, this ETF does have downside protection, but when you put it next to these funds, it seems like it doesn't even have any downside protection. Definitely leave a comment down below on your opinion on these funds, but personally, I would never go all in on these funds because they have their own sets of trade-offs. Over long periods of time, they're both going to lag the market pretty severely when it comes to total return, but that's not to say they don't deserve a small spot in your portfolio, perhaps like a 5% allocation if you want to minimize sharp declines. But that's going to do it for this video. If you guys are still watching and enjoyed, give the video a like, subscribe, all that YouTube stuff, and I'll see you in the next one.